when you're looking at bull market activities, there's all sorts of things you can do. And I guess if you put everything on a chart like I do, you have risk and let's say we've got activities. No, let's just say complexity / effort. So, and I guess if I was to try and complicate things, you've got ROI over here. So you've got full degen. Now, when I say full degen, this is you are heavily trading, doing all sorts of looping and borrowing and staking on all sorts of layer upon layer upon layer, etc. Just like in DeFi 2.0 in 2021, you could do all sorts of crazy degen stuff. So yeah, the risk is super high, the potential ROI is high, and the complexity and the effort is ridiculous. And you'll lose track because there's a lot going on. And the other thing that I have to stress is that, and what a lot of people kept on overlooking, and that's why I didn't go full degen in December, in summer of 2021, is that you have a layer. So it's all about the layers. You got layer one, right? So let's just take Ethereum or Avalanche or whatever, you know, a main layer one. So for DeFi at the time, let's say, I don't know, Avalanche. So you've got AVAX. And you're then doing some sort of, I don't know, thing, staking or borrowing, etc. You then got a layer two. So that'll be, you know, some other project. And then you got a layer three, let's say, that's sort of connected with that layer two, doing all sorts of, again, more DeFi looping and borrowing, or, you know, all that sort of stuff. And before you know it, and then also you got, I don't know, MetaMask or whatever. You got all sorts of different layers that are third party or counterparty risk, and all it takes is just one of these layers to break and you've lost everything. So, you know, you may have so whereas you have way less risk if you're only effectively exposing yourself to one layer, so to speak. Now obviously on this chart, complexity, effort, risk, etc., you know, spot blue chip. Obviously it's not a sideways line, it's just me trying to type it, I guess. Yeah, let's just do buying blue chip spots. That's the least riskiest thing you can do. You're not going to get levered, liquidated or stopped out. Complexity is easy. You just bung it on a Trezor. If you leave it on the exchange, you're way up here. So don't do that. ROI, probably, well, in the long run, I'd argue that just buying spot will probably outweigh all your degen stuff. So, and then obviously you got a mix in between. You can do all sorts, you know, up in here. Now, the thing that I want to talk about is what I've actually done is that you don't have to go full retard. You you can do a bunch of other stuff. So I would say that a slightly set, you know, it's more active, obviously, so it's further along this complexity effort curve, but you can do staking for the long term and borrowing for the long term and inverse trading without being crazy, if that makes sense. So 1 second, just is my camera stopped working. Here we go, back in the room. Right, share screen. So what exactly do I mean? Well, if we're to tie these three things together, let's have a look. So imagine, so Bitcoin is coming off the end of a big old crash, it's rebounding, and like my cycles, in fact, let's be better. let's look at this. So weekly chart, we're on the log. Let's just zoom in a little bit. There we go, and take a screenshot. Cool, right. And just before you know it, Bob's your auntie. So where are we now? We're halfway through roughly the sideways accumulation zone. Now, we've got three things that we're going to talk about. We've got borrowing, we've got inverse trading. I'll explain that in a sec. And we've got staking, right? You have to know when to do that. You don't want to be doing any of these sorts of things, you know, at the top of the bull market. The best time to do all of these key things is if you can time it, the sweet pico bottom right down there, or when you know that the actual bottom is in the rear view mirror and it's basically up from now, which I am strongly confident that we are in this position. I do believe that we are here, and that in the medium term, up to 2025 December, that it's basically up. Okay, yes, we could drop down to 23.20 maybe, but for all intents and purposes, especially for this thought experiment, it's just up from now. So what you could do is a couple of things, if you're not just doing the spot. So first of all, you could buy a bunch of, let's take ETH, right? So you could spot ETH. So you're buying spot ETH. And that way you hopefully ETH is going to do something similar and just do, you know, obviously if Bitcoin's going up here, ETH will do, you know, better returns, especially as the spot ETF is coming out. And by the way, that's a much bigger deal. So a spot ETF for ETH is a much bigger deal than having a Bitcoin one, because if you just look at simple market caps, you know, Bitcoin is pretty big, 500 million, but look at Ethereum. It is, you know, it's more than half the size of that. So even if you have you know, $1 trillion spot ETF, I mean, that's going to do a lot more for the price than, you know, Bitcoin would. So especially with its deflationary model, and, you know, all the things that the West loves about it, with, you know, ESG friendly and all that bollocks. So you buy spot ETH. You can then do DeFi borrowing. So remember at the cuddle where I talked about how you deposit the ETH and borrow the shittiest stable coin possible, hoping the stable coin crashes. DeFi borrowing. Okay, and you're doing this all, you know, now, let's say. Then what you could do is you could then take that borrowing, buy more spot ETH. Okay, so you take you know, you're leveraging up. Let's say you take a, I don't know, 70% loan, so of whatever you deposit. You're then getting a shitty stable coin, you're buying more spot ETH. And then from here, you can do a bunch of different things. So you could either do, let's just say, inverse trading. Now, inverse trading basically means where you deposit Ethereum, onto your trading platform, and then you can still do perpetual derivatives, just like you had deposited USDT. So, for example, I deposited a very small amount of ETH onto Bybit the other day. So if we go to this, so although it says USD, actually it's in ETH. So I've got no USDT. Technically, I'm minus $1, etc. But look at the ETH. So I've deposited the ETH, but I can still do derivative trading, just like I had done before. And so, guess what? as ETH goes up in price, technically, so too does the amount of margin that you have to play with, which is great. So that way you don't have to have a pot of, USDT stuck there in Bybit, not growing, just so you can trade. Now, the reason I haven't done inverse trading in the past is because, let's go back to this picture. For the best part of a year and a bit, what have we been doing? We've been falling. So of course I don't want to have Ether there as my collateral, because that's just going to be a shrinking ice cube. And that's why we've had USDT, which, crazily is the best stablecoin at the moment, and it still is, which is barking mad, honestly. We're way up here, $83 billion, whereas everything else still seems to be bleeding out. Yeah, Binance is dying. Oh, okay, my arrow hasn't happened yet. DAI stayed flat, but we'll see what happens there. And TUSD, not much actually. It seems to be growing, doesn't it? So, but yeah. So you can then deposit your ETH to do inverse trading. That's one thing you can. That's a way that you can do some double utilization of it. That way that you don't want to be parked in stablecoin, because that's money that's not going anywhere. Or you could stake for the long term. Now, staking opens up a whole bunch of stuff. So you can do, I don't know, let's call it safe staking, or dodgy staking. These are my words, by the way. You won't be able to Google this. Staking. Now, what I mean by dodgy staking is so you got some ETH, right? Whether you've borrowed from a lending platform and then bought more spot, or you just go from point one to this. So what you do is you go to a platform. It'll be like some sort of layer 2 where they can give you liquid staking. But the key part of this, and why I call it dodgy, is that they give you a receipt for it. Receipt. Now, this is otherwise known as a tangible, or like a token for it. So let's say you've deposited 10 ETH into staking. What you'll then get back from that is 10 staked ETH. And because it's a valid token, you can take that 10 staked ETH and then play with it. So as you can see, you're adding layers of risk here, because what you can then do is go, oh, actually, I'm going to take my 10 staked ETH and then go and do whatever you want. You could trade it. You could then borrow off of it. You can literally park it into something to borrow from, and then you can loop it around and do this all over again. You can deposit it as an LP, as in you could basically put it into a pool and become a liquidity provider. Then you'll get some interest, because people will then borrow and play with your staked ETH. Remember, staked ETH is effectively like a bearer bond, and a bearer bond or a bearer share is where you had a lot of bearer shares and bearer bonds back in the olden days, where it's basically a piece of paper, and whoever owns that piece of paper owns the company or owns the bonds that it represents, and you don't need a paper trail. It was big in the 70s, especially with crooked billionaires and stuff like that, because if you had them in your safe, guess what? That is your property. But if someone broke in and stole them from you, then good luck. You tough shit. Whoever owns them, whoever holds them, owns the shares or the bonds. So this is what I call a bearer asset. So yeah, which means that if you lose it, like you blow it on the markets, or the liquidity pool that you plonked it on goes bust, tough shit, you've locked it and you still owe the money that you've so that, I mean, this is going full DeFi, degen, so to speak. And personally, when you're looking at all the potential things that you can do, all of this stuff, it's just not worth the effort. It's not worth the effort, the complexity. You got to track it. From a technical standpoint, I mean, there's so many taxable events here. It's ridiculous. Every time you do a single thing is technically a taxable event. So if you're living strictly by the book, you are going to be probably treated as trading income, all of this, and then you're going to be taxed even more, unless you have a really good accountant like mine, who again is above the board, but above the book, but knows how to move things around properly. So I just wouldn't bother. So that's my thing. So you can see all sorts of YouTube videos that will go into really sexy, snazzy stuff, but I'm just gonna nah. That's my personal opinion. Just, is it worth the effort? And really, what is the alpha, or what is the delta uplift from someone that just buys spot ETH and stakes it in the safe way? I think it's not much of an uplift. So if anything, yes, do some inverse trading for sure. And because on Bybit you can leverage, you got leverage here. You don't actually need to park too much of that because it is a centralized exchange. Don't forget. You can do inverse trading on GMX as well, by the way, and there'll be other dexes that allow you to do that. So you don't have to leave it on a centralized exchange. It can stay in your wallet, like if you trade on GMX. So that's an added bonus. Yes, you could do some borrowing. Again, I wouldn't have more than a 70% borrow or 70% loan to value. If you wanted to be super safe, just do 50%. But I think you can get away with 70, especially where we are at the moment in the market. Maybe wait for see if there's a bit more of a flush out. You can get away with 70, 75. But I think for the long term, like let's just say Ethereum has a similar growth chart, right? Because I want to show you the real value of safe staking Ethereum for the long run, because this is a way that you could, and I spoke about this a lot in 2017. So for the older veteran RT students here, sorry, you're gonna have to hear it all over again. But there are a lot of people that haven't seen me talk in 2017. But let's have a look at ETH on the log chart. Here we go. So let's just clear all these charts. Now, unfortunately, it's not as clear. Oh, sorry. Let's get onto a proper chart, not Bybit. This ETH, USDT. Let's go into the Bybit one, Binance. So compared to Bitcoin, it's not as easy to see. There's no real cycles or not any discernible cycles which are obvious. I think, I mean, you looking at fractals, I guess there's similarities between this low and this low. Like here we had sort of it's like a weird double bottom type thing, and we had the same sort of thing over here. Then this part here was this bit here, and then we had a bit of a sideways movement where, so there are similarities, but yeah, let's just ignore that for the moment. I guess not that, on a log chart, straight lines don't really work on log charts too well. They're more of a bendy type thing. But let's just say, we saw ETH getting up to, $9,000, call it $10,000, which I think is, a fair shout, to be honest. We've got some awesome upside here, for what you can do with ETH. Now, the safest one, I'd put my head out there and say Ethereum is going to be the safest coin that you are going to stake if you're looking to stake something for the long term. And the benefits of this are genuinely crazy. If you want to have, whether it's bear market or bull market, and you can always time it, by the way. You don't have to just sit on it for the next 10 years. You could basically do it, until December 2025, and then stop staking, and then just to see if there is a crash, and then do effective sidestep potentially. But let's just say you don't. Let's just say, come rain or shine, you're just going to stake your ETH for as long as you freaking can. And we know that we've got the top cover of BlackRock and Vanguard pouring into Ethereum ETFs, etc. So it's going to be here a long time. So the simple maths behind it is, I don't know, let's say you've got 100 grand. No, let's make it more realistic. 10 grand, right? 10 grand of ETH right now. You go and buy that. What's the price of ETH? The price of ETH is 1621. Let's just do this. So 1621. So we do 10 divided by 1621. You get 6.169 ETH. 6.169 ETH, right? So what you're going to do is you're going to stake that somewhere, and you're going to stake it somewhere as safe as you can. Now, the safest way, by the way, you could do solo staking where you're staking it on the network, but you've got to lock it up. And I mean, hell, if you had, actually, I wouldn't say it depends how techy you are, because if you run a node and you do it that way, if you don't have proper uptime, you could get slashed. So not only could you not get some rewards, but you can actually lose your ETH if your node or your validator isn't reliable. So I probably wouldn't do that. I would look for some sort of liquid staking platform. Now Lido is pretty much one of the biggest out there, but I'm not going to name names of where you can do it. Just do liquid staking where you can pull out, no more than a week lockup. I mean, most of the time it will instant unlock if you want, but I really wouldn't have more than a month lockup. I just personally, I do not like 30-day lockups, which happens with a lot. I know I used to stake Polkadot quite a lot. In fact, I've still got some dot staked in some ledger somewhere. But anyway, liquid staking. Now, you're going to take a little hit. So I wouldn't leave it on Kraken or, a centralized exchange to do it. But let's just, I don't know, 3.5%, I guess. That was average ETH staking yield. And then there's another one, which was stakingrewards.com. So staking rewards, I haven't looked at this for a long time. Here we go. Let's go to Ethereum. Reward rate is 4, yeah, but if you're, let's look into this a bit now. So real reward rate is around 4%, but if you're going to put it on another, like a liquid staking thing, they take it, their business model is simple arbitrage. They stake it for you, like on Lido, etc. They top slice it, and then you get less. So let's just say 3.5%, and that will fall, by the way. So what have we got? So staked ETH. God, they got it. Yeah. So there's a lot of staked ETH at the moment. What is that as a percentage? I can't see at the moment, but around 4%. Let's just say 3.5%. If you did it on Coinbase, it's about 3.35. So yeah, if you did it slightly better, you probably get a bit more. So what this means is that, let's just do 3.5%. You get the yield in ETH, by the way, which is beautiful, because if you look at end of year 1, and then 2, 3, 4, 5. Let's say it's going to take a while to get up there. So I'll open up for questions in a sec. I just want to get this last bit done. 1.035. You then got 6.3. Whoever's hot micing, could you please mute yourself just for the moment, buddy? Whoever it is. I'm just going to mute all. Then you can unmute later. So that, and then if I press it again, and then again, so 1, end of year 1, year 2, year 3, year 4, year 5. So 7.326. 7.326. So, by the way, so what I'm about to show you, the reward yield curve looks a bit like this. So let's just say eventually ETH, let's say within 5 years, it does get to $10,000 in ETH, which is not too hard to assume. And the difference here is 7.326 minus 6.38. No, you started on that. 326 minus 6.169 is what we started. The difference is 1.157 ETH. So if you then divide that by 1.157 divided by 5 years, you're looking at 0.23 a year, 0.23 per year. And then obviously if you divide that by 12, you can sort of work out 0.019 per month. So obviously, as I said, the curve is going to be a bit like this, but what this essentially means is that if ETH is then $10,000 each, it's that times 10,000, which means you've got $192.8 a month coming in. Annualized, or if that makes sense, which is great, all from 10K, by the way. So that times 12, what was that? Yeah, so you're looking at something like 23% yield, so to speak. And that will happen, you'll get the yields every month. So it's going to start slow, but then eventually, if price goes crazy like 10K, so part of me, by the way, does want to just lock in a relatively large amount of Ethereum, let's say 250 grand's worth of Ethereum, and just let it sit there forever, fully staked. And the yield that I would get from that will be, quite nice. Even at current prices, it will be, not a kick in the teeth, but better than nothing. Because the yield is, the 3.5% is pretty pants, but that's compensated by the potential price appreciation. Now, personally, I see Ethereum 20K in a much shorter time frame than people would imagine, but